Unmasking the illusion. Financial history reveals a recurring trap, the allure of predicting tomorrow's wealth by clinging to yesterday's patterns. In the late 1990s, a wave of optimism swept through markets, fueled by bold claims and blockbuster books. A 1994 bestseller heralded stocks as a timeless golden ticket, setting the stage for a crescendo of titles like skyrocketing to 50,000, climbing to 60,000, and soaring past 150,000 by 1999. These works leaned on a simple refrain. Stocks had historically delivered 7% annual gains after inflation since the early 1800s, proof, they argued, of a reliable future bounty. Some pushed further, asserting, stocks always outpaced bonds over any 30-year span, rendering them as safe as cash in the long run. Why, then, worry about the price paid today? Yet this rosy lens ignored a brutal truth. High peaks often precede deep falls. By late 1999 and early 2000, the hype was palpable. Fund managers, portfolio strategists, and analysts alike dismissed warnings of overvaluation. Biotech stocks trading at astronomical multiples were dubbed colossal opportunities. Stellar firms were golden geese, too precious to abandon despite their lofty costs. The notion that pricier stocks weren't riskier was floated with confidence. The reckoning came swiftly. Between 2000 and 2002, the market erased trillions in value. Biotech darlings plummeted, some by 65%, others by 99.8%. Tech giants shed over 75%, with one vaporizing $500 billion in market cap. Major indices retreated, wiping out 7 years of gains. The late 90s boom, mistaken for a permanent ascent, proved a mirage. The flawed echo of history. The claim of stocks enduring supremacy over bonds rests on shaky ground. Pre-1871 data is sparse, often tracking just a handful of companies, sometimes as few as 8. Yet by 1800, the U.S. hosted roughly 350 ventures, from bridges to wagon trails. Most failed, leaving investors empty-handed. These flops vanish from the record, overshadowed by survivors like banks founded in the 1790s. This winner's lens inflates early stock returns, pegged at 7% annually after inflation from 1802 to 1870, against 4.8% for bonds and 5.1% for cash. Skeptics argue those stock figures are overstated by at least 2 points, suggesting equities barely edged out bonds or cash, if at all. Banking on history as a sure bet is a gamble on thin ice. The cost of blind optimism. The late 1990s exemplified this peril. With inflation low, profits rising, and global stability in sight, stocks soared, up 22% annually from 1995 to 1999, a streak unmatched in U.S. history. Expectations ballooned. By 1998, investors anticipated 14% yearly gains. By 2000, 19%. Even professionals succumbed, with pension funds hiking return forecasts to record highs by 2002. When the crash hit, those hopes cratered. Expectations fell to 6% as stocks halved in value, and lofty pension bets promised billions in losses. The lesson is stark. Chasing past streaks breeds reckless bets. On March 31, 2000, U.S. stocks peaked at $15.2 trillion. By October 15, 2002, $7.8 trillion had vanished, over 51% gone in 30 months. Pundits flipped from euphoria to despair, predicting flat or negative returns. The louder the cheers for stocks' long-term promise, the sharper the short-term sting. Pricing the future in investments' worth hinges on its price. Always has, always will. Companies generate finite value. Paying beyond that ceiling defies reason. Consider a star athlete drawing crowds and justifying a multi-million-dollar salary. But would 10 times that amount, or 100, still make sense? The returns wouldn't match the cost. Stocks follow the same logic. When prices inflate beyond earnings potential, future gains shrink or vanish. A clearer view emerges from 3 drivers of stock returns. True growth. Profit and dividend increases. Historically, 1.8%, to 2.2% annually before inflation. Price creep. Inflation, averaging 2.5% in early 2003. Fever swings. Market sentiment, lifting or sinking valuations. At a 2% dividend yield, and long-term returns might range from 6.3% to 6.7%, or 4.5% after inflation. Greed can juice short-term spikes, fear can drag them down. In 2003, with sentiment cooling, a decade's gains might hover near 6.5%, 4.3% post-inflation. Modest compared to the 90s, yet competitive with bonds. History's only certainty is its unpredictability. Markets thrive on upending smug forecasts. Building resilience, how much risk to embrace depends less on assets than on temperament. Two approaches stand out. The active path. A dynamic mix of stocks, bonds, and funds requiring research and adjustments, ideal for those who relish the hunt. The steady path. A low-maintenance portfolio demanding discipline over excitement, suited to those seeking simplicity. Both succeed if costs and emotions are controlled. Risk isn't just external, it's internal. For the steady path, a starting split might be 60% stocks and 40% bonds, rebalanced biannually. Bonds buffer panic, preventing sales at lows. Psychology proves people overestimate their calm in a storm. Life's realities, stability, obligations, cash needs, shape the mix more than age. A wealthy 30-year-old might favor stocks, a strapped 22-year-old might not. Adjust only when circumstances shift, not market whims. Beyond stocks, income options, bonds and cash alternatives offer stability, with choices expanding. Treasuries. Near riskless, with short-term bills dodging rate hikes and long-term bonds riding them. Municipals. Tax-free for most, best outside retirement accounts. Funds. Affordable diversification, outshining individual bonds for smaller sums. I-bonds. Inflation-linked, yielding 4% in 2003, though locked in. Mortgage funds. Around 4.5%, reliable with skilled management. Stocks with dividends rivaling bonds can supplement, but their foundations must be vetted. The humble investor's edge. Skepticism is the shield against hype. Lowered expectations, paired with hope, navigate market's twists. The bleakest moments often precede the brightest turns. History favors the humble, those who cap bets, diversify, and endure surprises. Blessed are those expecting little, for they may yet gain much.